Hello friends, how are you? I hope all of you are doing really good, and I really hope that all of you are enjoying this revision series of financial management. And if you're enjoying it, first of all, hit the like button on this video and subscribe to the channel. And if you have not yet done it, share with all your friends. That's you know what you have to do it. Okay, so let's continue with our discussion now. Very important chapter that we are going to start in this lecture, and we'll divide it into two parts. That is capital budgeting, or what we call it as investment decisions. It is one and the same thing, whether it is capital budgeting or whether it is investment decisions, right? Investment decisions, it is one and the same thing, right? Capital budgeting or investment decisions, very important chapter from the examination point of view. At least 10 to 15 marks we can expect the question from this chapter. At least 10 to 15 marks questions we can expect from this particular chapter. This is such a great chapter, sir. This chapter in itself is a syllabus, right? You can ask around 20 to 30 marks easily from this chapter. You have so much of the content in this chapter to be asked, right? So let's start with what is investment decision and what is the capital budgeting. It means one and the same thing. Now, when we study the basics of financial management, in that we say that there are three basic decisions. One is investment, another is financing, then is dividend decision. Now, under the investment decisions, what we are trying to identify is that where to invest your money, right? That is what he says. The process of deciding whether or not to commit the resources to a capital investment or project whose benefits would be spread over several years. For example, you want to buy a car, right? Now the car is not like something you will get it for 1000 or 2000 rupees. No, sir. It will involve a huge amount of resources. 5 lakh, 6 lakh, 10 lakh, 12 lakh, 15 lakh, 20 lakhs. That is going to be in the lakhs. The investment is going to be in the lakhs. Now you have to decide. You have to decide in which of the cars you want to invest your money in, which car will serve you the best, which car will give you benefits over a period of time. It is not like that today you will buy a car worth 10 lakh rupees and tomorrow you will say, sir, I'm not interested in this car. Let's sell this car and let's go to some other showroom and buy some other car. Are you going to do that? No, sir. Right? If you are going to do that, that means you are some sort of a Ambani or Adani, right? Even they might not be doing it, isn't it? So this is what is there, capital budgeting. So capital budgeting helps in identifying the right car for us, the right project in which we should be investing our money, because the benefits are spread over a period of year. The investment, that is huge investment you have to do today, and considering the future aspects, that in the future whether we are going to get benefit from that project or not, that you have to decide today itself. Although we say the future is quite uncertain, that is why there is a chapter risk analysis and capital budgeting. Afterwards we'll be doing that, right? But for now, capital budgeting is the process of deciding whether or not to commit the resources to a capital investment. Capital investment means that is a huge investment, that is an irreversible decision, and the benefits are going to be enjoyed over a period of time, right? So basically three types of decisions, projects are there, decisions are there. That is mutually exclusive project. If there are two projects under consideration, for example, if there are two cars under consideration, one is the Hyundai, another one is Maruti, and you buy the Hyundai car, will you buy the Maruti car also? No, sir. The Maruti option is automatically gets rejected. So the acceptance of one project will automatically lead to the rejection of the other project. That is known as mutually exclusive projects. The second is independent project. The acceptance of one project will not lead to rejection of the other projects. More than one projects can be accepted if they are not dependent upon each other. These are independent projects. You can accept all the projects which you think are going to be beneficial for you, right? Then is complementary. Complementary is if you accept one project, you will have to compulsorily, you will have to accept the other project also, right? Acceptance of one project requires the acceptance of the other project also. For example, if you want to set up a factory in the remote area where the roads are not good, if you accept that project, then you will have to accept the project of building the roads also, right? That will lead to your factory. You will have to accept that project also. That is known as complementary project, and each project involves a huge amount of money. That is very important, sir, right? And the decisions are going to be irreversible. So these are the few things regarding the capital budgeting. Now, most important part is techniques of capital budgeting. If we talk about the techniques of capital budgeting, these techniques can be divided into two parts. One is the non-time adjusted techniques. One is non-time adjusted techniques. That is, they do not consider the time value of money, right? Another one is the time adjusted techniques. Time adjusted techniques, right? That means they consider that with the passage of time, the value of money changes. With the passage of time, the value of money changes. In this, we will be doing ARR and the payback period, and here we'll be doing discounted payback period. Then we'll be talking about NPV, then we'll be talking about IRR, then we'll be talking about PI, then we'll be talking about what? Then we'll be talking about MIRR. So these are the major techniques under the time adjusted techniques, right? So starting with the first one, that is the non-time adjusted techniques, that is they do not consider the time value of money. The first one is the average or the accounting rate of return. It shows the annual average earnings divided by average investment into 100. That means today, if you are going to invest 10 lakh rupees in a particular project, then every year in the coming times, if that project is going to be for 5 years, in the next 5 years, what will be your profits from the business that you will be generating? That is what is average annual average earnings. That means today, if you are going to invest 10 lakh rupees in a project, then tomorrow from that project, what will be the earnings from the business operations? What is that rate of earnings that you are going to earn, right? That is why it is known as accounting rate of return, where the average annual earnings is equal to annual earnings divided by total project life. That is, if in the year 1 you are going to earn 10,000 rupees, in the year 2 also you are going to earn 10,000, in year 3 you are going to, let's say, 20,000. So and the project life is for 3 years. So what will be the average annual earnings in this case, sir? 10 plus 20 divided by 3, that is 40 divided by 3, that will give you the annual earnings, that is 13.33, 13,333 rupees. This is going to be the average annual earnings. Now this average annual earnings is what? This average annual earnings is the earnings after tax and depreciation. Earnings after tax and depreciation. That means we subtract the depreciation also, right? But before interest on debt. Now interest on debt will be required for the taxation purposes. That means if we talk about the average annual earnings, we have already studied about EBIT, right? Okay, let's not talk about EBIT first. We'll start from sales, right? Sales minus total cost. I'll say total cost. Total cost means including depreciation, right? So this will give me the earnings before interest and taxes minus interest on debt. Now interest on debt is a tax deductible expenditure, sir. From here, what you will get is EBT, right, minus taxes. What you will get is EAT. Now, if you want to calculate the average annual earnings, annual earnings, what will be your annual earnings, sir? I'm talking about this annual earnings, sorry, not average annual earnings. I'm talking about the annual earnings, right? I'm talking about this annual earnings. What will be the annual earning? The annual earning here will be EAT, that is earnings after tax plus interest on debt. Right? So this will give you earnings after depreciation and tax but before interest. So this is your annual earnings. Now moving on to the second part, total project life is fine, sir. This is average investment. Now what to do with the average investment, sir? Here we have given opening investment plus closing investment divided by 2. What does it mean, sir? What does it mean? Let's try to understand now the average investment. This is important. Please listen to it very carefully. Average investment, right? Now, there are several options. There are several ways in which you can calculate the average investment, sir. For example, what is investment? The investment is at a zero period. This is your zero period. That is today you have a cash outflow. That is you have invested, let's say 10 lakh rupees, right? Let's say you have invested 10 lakh rupees today. And after, let's say this is a period of 3 years or 4 years project. This is 1 year, 2 year, 3 year and 4 year. Here you might have some salvage value or you might not have some salvage value if you are investing in an asset. Let's say it is a 10 lakh asset that you are investing in, right? And the life of the asset is 4 years. After 4 years you can sell the asset and get a salvage value. So one option is, so this is one option is to take only original investment, as average investment, right? That means you take 10 lakh as the average investment. This is your average investment. So this is one way of calculating it, but this is very less we are going to use this, right? This is the least option that is used. Now, what is the second option? The second option is, let's say today you have invested 1,20,000 in a project, right? So this is the investment that you have done. Investment means this is a cash outflow. Okay, we'll not talk about cash outflow because we are talking about the ARR. I'll say this is an investment, right? And after, let's say maybe 5 years, 1, 2, 3, 4 and 5. Let's say after 5 years, you are getting a salvage value of 20,000. And depreciation is on SLM basis, that is on straight line method basis. Now, in this case, you can calculate the average investment by two ways. What are the two ways in which you can calculate the average investment? The average investment can be opening investment. It can be opening investment plus closing investment divided by 2. What is the opening investment here, sir? The opening investment is 1,20,000. What is the closing investment here? That is 20,000 divided by 2. So that will come to 70,000. Right? 1,40,000 divided by 2, that is 70,000. Another way of doing it, he says, sir, this 1,20,000 you have invested, 20,000 you are going to get back. So actually, what you have invested during this period, actually you have invested only 1 lakh rupees, sir. This 20,000 you are going to get at the end of the period anyhow, right? So what is your actual investment? That is 1 lakh rupees. So he says, in this case, average investment can be calculated as average of opening investment minus salvage value, right? That means the average amount will be from this 1 lakh rupees, not from 1,20,000 and 20,000. He says, do the average of this 1 lakh because 20,000 you are anyhow going to get at the end of the period. What is the average amount that is invested is dependent upon that 1 lakh rupees, right? So average of this plus the salvage value, right? So half of what is the opening investment, sir? 1,20,000. What is the salvage value, sir? That is 20,000. Here you will add salvage value. Why, sir? Because this is invested, sir. The money is anyhow invested. Only for the purpose of average, you have to take the opening minus salvage value. So this is 1 lakh divided by 2, 50,000 plus 20,000. Right? So this will come to 70,000 rupees. So this is another way of calculating the average investment. In these two ways, you can calculate average investment under if the depreciation is on straight line method basis. Normally, the depreciation is given on straight line method basis, and accordingly, you will have to calculate it like this. Now, if working capital is available, another point is if working capital is given, if working capital is given to you, then what will you do regarding the working capital, sir? Then how the average investment will be calculated? Now, in this case, the average investment, you will have to add now working capital. When the working capital is going to get issued, here only, sir, add working capital. Let's say it is 10,000 rupees. Now this 10,000 is also invested during the life of the project, right? At the end of the project, what we take is return of working capital, that this working capital will be returned, but this 10,000 will be utilized over a 5 years. At the end of 5 years, you will return back the 10,000 rupees which you have taken as for working capital. So average investment will be opening investment plus working capital plus then closing investment plus working capital divided by 2, right? This is one way of calculating it. Or another way of calculating is average of opening investment minus salvage value minus working capital plus salvage value plus working capital. Again, he says, what is the average amount that is investment? The working capital is invested, but it is not going to be depreciated. The average value you have to take it for opening inventory minus salvage value minus working capital, right? After that, you have to add it because this amount will be invested but not average. The full amount will be invested. Why we are doing the average here, sir? Listen to that very carefully. Sir, 1,20,000 you have invested in the machinery. At the end of the period, let's say there is a 10% depreciation. Now the value of the machinery will not be 1,20,000, right? That is going to be 1,20,000 minus 12,000. This is going to be 1,08,000 here, right? Again, there will be depreciation. So at any point of time, there are different values which are invested. That is why we are taking the average value. So he says the salvage value is already invested to the full amount. You are going to get 20,000 rupees at the end. What is the depreciation that you are calculating on? 1,20,000 minus 20. Even if you want to calculate the SLM depreciation, how will you calculate it, sir? How will you calculate depreciation? That is 1,20,000 minus salvage value divided by 5, isn't it? This is how you are going to calculate the depreciation, na? So that is why he says here you have to subtract the salvage value. Again, here you have to subtract the working capital also, sir. The working capital is not going to be depreciated. Clear? All this is possible when you are following the straight line method, not the WDV method. Sir, what will happen in case of a WDV method? In case you are given the WDV method of depreciation, then in that case, how will you calculate this average investment? Let's see. I'm going to take a very simple example, a small example, right? Year, I'll take not year one, I'll take year here. Then I'll take opening investment, right? On this, you will calculate the depreciation on this. Then you will get closing investment, right? Then what we are going to get is the average, then working capital, and then total. How you have to do it? Sir, you in the year one, what is the amount you have invested, sir? In the year one, what is the opening investment? That is 1,20,000. What is the depreciation? Let's say it is WDV at 10%, right? WDV at the rate of 10% is the depreciation. Now 12,000 is going to be the depreciation. What will be the closing inventory? 1,08,000. What is the average of it? How will you calculate the average? Average will be opening investment plus closing investment divided by 2. 1,14,000. Now, let's say 10,000 is the working capital. So, average is not to be done for the working capital, right? So, here you will write 1,24,000. In the second year, what will be the opening investment, sir? This will be the opening investment, 1,08,000. Now, what will be the depreciation, sir? 10% of this value, because we are calculating on written down value. Sir, 10,800. What is the closing inventory? 97,200. What is the average now? Average is opening plus closing divided by 2. That is 1,02,600. Working capital, sir, 10,000. It will be included separately. And so on. If it is for 5 years, let's say 3, 4, 5, you can calculate it for 5 years. And then you can write the total here. So what will be the average investment? Overall average investment, sir, that will be total divided by 5. This total divided by life of the project, that is 5. So this is how you will calculate it in case of WDV. In case of SLM, you can straight away use these formulas for calculating the average investment, right? So this is all about the average or the accounting rate of return, right? Now, in the capital budgeting, this is the only technique which is using the accounting profits. Sir, what about the other techniques? Other techniques are not going to use the accounting profits? No. Other techniques are going to use the cash flows. What other techniques? Sir, this is the only technique. ARR is the only technique which is using the accounting profits. The rest of the techniques, what they use is they use cash flows. Right? What do you mean by cash flows, sir? The cash flows means the cash outflows and cash inflows. That means all those transactions which involve the actual cash flows, right? Transactions involving actual cash flows, right? So any transaction which involves the actual cash flows, those transactions are to be considered in rest of the techniques which we will be discussing, right? So can you give an example where there is an expenditure, there is a cash outflow, there is an outflow, but that is not a cash outflow, that is depreciation. Depreciation is the biggest example where you have an outflow, where you consider it as an expenditure, but it is not a cash outflow. There is no cash, actual cash which is being given here in case of depreciation, right? So let's see what is the effect of depreciation on the cash flows. Very important, sir. What is the role of depreciation, sir? If the depreciation is not a cash outflow, then is there any role that the depreciation is going to play? Yes. Depreciation is a tax deductible expenditure. The depreciation will be used only and only for the purposes of the taxation. Depreciation plays the role of tax saving because you can claim depreciation as an expenditure and thereby reducing your profits, thereby reducing the taxes to be paid. Right? In the case of cash flows, what is the effect of depreciation? EBIT is there, less depreciation. Let's say in the EBIT, the depreciation is not subtracted. Sorry, not EBIT here. The interest is to be, okay, that's fine, sir. EBT, you will get EBT, sir. Instead of EBIT, I'll write, because interest we are not going to take anyhow. Interest on debt we are not going to take anyhow. That is profits before depreciation. Profits before depreciation. Right? And taxes. So this is what I can write. Profits before depreciation and taxes less depreciation, you will get earnings before taxes. Now depreciation you have subtracted. Now on this profit you are going to pay the taxes. If you do not consider the depreciation, then on this profit, let's say this is 10,000, 1,000 is the depreciation. Here you have 9,000 rupees. Now if you want to pay taxes at the rate of 50%, you will pay 4,500 as the tax. If you do not consider depreciation, then what will happen? Sir, you will have to pay tax on this. 5,000 rupees you will be paying taxes. So depreciation helps in the tax saving, right? EAT, but after you have calculated the earnings after taxes, he says you will have to add back the depreciation. Why, sir? Because depreciation do not involve actual cash outflow. So because there is no actual cash outflow, I will first subtract it only for the purpose of calculating what is the tax saving. After that, I will add back the depreciation to find out actual cash flows after tax. Right? We call it as CFAT. Right? So we want to find out what is the actual cash flows after taxes. The depreciation is considered only and only for the purpose of tax saving. After that, we add back the depreciation. This is very important, sir. I know some of it was, the myth was created that depreciation part has been removed from capital budgeting. No, sir. The depreciation part cannot be removed at all from the capital budgeting. Not at all a possibility. It cannot be, sir. It cannot be removed. So forget about it. Right? Please do not go after any such rumors. Now, what about the additional working capital, sir? What will happen in case of additional working capital? Let's say you are at the zero period, you are investing in a project, you have a cash outflow of 1 lakh rupees, and for implementing the project, for once you are going to start with the project, you need money for day-to-day expenses, isn't it? So here you will require the working capital also. Let's say 10,000 is the working capital that has been issued to this particular project, right? And the project is for, let's say, 4 years, right? 1, 2, 3 and 4 years is the project life. Now what will happen with the working capital, sir? Working capital will be utilized, right? At zero period it will be considered at zero period it will be considered as a cash outflow, right? It will be considered as a cash outflow because the business from its pocket is giving the working capital to this particular project. At the end of the period, if nothing is mentioned in the question, it is considered that at the end of the period, this working capital will be returned. That is return of working capital. But it is not necessary that working capital will always be at the end of the period. It can be here also, here also, here also, right? But if nothing is mentioned, if the question is silent, then you have to assume it. Always we are going to assume it that the working capital will be returned at the end of the life of the project, right? If question says if it is returned at the end of 2 years, then you have to take it here. At the end of 3 years, you have to take it here. But if the question is silent, then you will assume that it is returned at the end of the life of the project. To be treated as a cash outflow in the year of issue of working capital. Now, it is not necessary that working capital will be issued at zero period only. It can be issued at first year also. It can be issued at second year also, right? So you have to be very careful with the question, when are we issuing the working capital and when are we getting back the working capital. At the end of the useful life of the project, to be treated as cash inflow. If nothing is mentioned, if the question says if the time period is something else, you have to take it accordingly. Clear? Now, regarding the sale of an asset, sir, when you are investing in some new asset, let's say you are selling the old asset. Now, what will happen if there is a sale of an old asset? Let's see. The next is sale of an asset. Try to understand. Sale of an asset. What we are going to do with this sale of an asset? When we are talking about the sale of an asset, for example, the book value of the asset, that is in the books, the value is 10,000 rupees, and the sale value, when you go to the market, you are able to sell it for 15,000 rupees. That means you are earning a profit of 5,000 rupees. Now, how to treat this in capital budgeting? First of all, the sale value of 15,000, this will be treated as cash inflow in the year of sale. Obviously, you will be getting 15,000 and you will put it in your pocket. That is a cash inflow. This is an actual cash inflow, right? What about this 5,000, sir? Now, when you are earning the profit, you sold the asset, you have earned a profit of 5,000 rupees, the income tax department will immediately approach you. They will say, sir, you have earned a profit of 5,000 on the sale of an asset. You will say, yes, sir. They will say, pay tax on that, right? So you will have to pay tax on profit. Now you will have to, when you have to pay it, what is pay, sir? This is to be treated as cash outflow, right? This is to be treated as a cash outflow. On the other hand, there can be another situation. The other situation can be the book value is 10,000 rupees. The sale value is 9,000 rupees. Now there is a loss of 1,000, right? What will happen, sir? This 9,000 is your cash inflow. That is absolutely correct. On this loss, we will assume that this loss can be carried forward to the next year. And what will happen with that? Sir, tax savings. There will be tax savings on loss on sale of asset. Loss on sale of asset. Right? And this tax saving will be treated as a cash inflow. Right? That this loss we can carry forward into the next year. We will set off against the profits of the next year, which will reduce our profits, which will help in the tax saving with the reduced profits. Right? The set off of the profits you have already studied in the income tax, isn't it? Yes, sir. We have already studied about it. So this is regarding the sale of an asset. right? Tax paid on the profit on the sale of an asset, that is a cash outflow. And the tax saving on the loss on sale of an asset is a cash inflow. And the third thing is the value of sale value of asset. I'll write sale value of asset, right? That will be your what? That will be your cash inflow, right? So these are the few things that you have to remember regarding the depreciation, how to treat depreciation, how to treat working capital, and how to treat the sale of an asset, correct? Now, next, what all is included in cash outflows? The purchase price of the machinery, yes, sir, it is a cash outflow. Any freight, carriage, and installation expenses, that is also a part of the cash outflow that will become the part of your purchase price, right? The workers training expenses, yes sir, if you are getting any subsidy from the government, that is to be subtracted because that will reduce the price of your asset, right? That will reduce your cash outflow if you are receiving any subsidy from the government. After that, working capital, add sir. Additional equipment cost, add sir. Add retrenchment compensation. What is retrenchment compensation? Let's say you buy a latest machinery, right, worth 1 crore rupees. Now with that latest machinery, the number of workers which were already using the existing machinery were 10. Now you require only 5 workers on the latest machinery. You will have to, the 5 workers you will have to lay off, right? आपको निकालने पड़ेंगे सर 5 worker. Now those 5 workers will be sad. They are sitting like sad. You say, don't worry. Till the time you find a new job, we'll pay you the compensation, right? That is what is known as retrenchment compensation. When you are laying off the employees, when you are because of the latest technology implementation, you pay them the compensation. Yes, it is the responsibility, it is your responsibility to pay the compensation to them, right? And this is what? This is a tax deductible expenditure. This is a tax deductible expenditure. You can claim tax on this. That is why he says the tax savings on the retrenchment compensation, that will be a deemed cash inflow. Now this is what? This is your deemed cash inflow, right? Which will reduce the value of your outflow. So all these things are included in the cash outflow, right? Now when you have to calculate if there are installation expenses, freight, carriage, and installation expenses, and a subsidy, when you have to calculate the depreciation, how will you calculate the depreciation, sir? Listen to it very carefully. Another very important point regarding the depreciation, sir. For depreciation, what you need is you need the value of the asset on which the depreciation is to be calculated. What is the value of asset? That is the purchase price, whatever the purchase price you have paid, plus if there are any installation expenses, if there are any installation expenses, or if there is any freight, cartage, that will be included, sir. Any expenditure from the time you order the asset till the time the asset comes into the working condition, all those expenditures will be capitalized. All those expenditures will be included in the capital value of the asset. And if you are getting some subsidy from the government, it will be subtracted, minus subsidy from government, right? So this, on this value you will calculate depreciation, sir. Very important, be very careful, right? So this is the value on which you have to calculate depreciation. Sir, on working capital, no sir. On working capital, no depreciation. On any other thing, on retrenchment compensation, no sir, there is no depreciation on that, right? For the specific purpose of depreciation, you have to be careful with this thing. The purchase price is there, the installation expenses are there, subsidy from the government is to be subtracted. Clear? These small points are very important, and in most of the marathons, if you will look, these small points you will miss out, sir, and this is where we commit mistakes. That is why I'm focusing on each and every small point which can be asked in the question, right, sir? After that, the statement of CFAT. One is the cash outflows, one is the cash inflows. This is what is the cash inflows. This is what is the cash inflows after taxes. This is what is cash inflows after taxes. This is what is known as, we call it as, the sweet name that we call it as CFAT, right? Okay, in the CFAT, there will be multiple years, year 1, year 2, year 3, there will be the cash inflows will be over a period of years. The benefit, cash inflow means the benefits, and in the very first line we told you that the benefits will accrue over a period of years, right? So year 1, year 2, year n, it can be 4 year, 5 years, whatever. Sale unit, selling price, total sales minus total cost, including the depreciation, you will get earnings before taxes minus taxes, earnings after taxes, and here you will have to add back depreciation. Sir, you will have to add back depreciation, sir. Right? That is where we get the cash flows after taxes. Now, here certain other adjustments will be there. The release of working capital. Whenever you are getting the working capital at the end of the life, we just discussed about working capital, that if nothing is mentioned, we will get the return of working capital at the end of useful life. That will be treated as a cash inflow, right? At only in the last year. Cash salvage value of the asset. If the existing asset you are going to sell at the end of the life, if it is not an old asset, here we discussed about the old asset, sir, it means the one and the same thing. The sale of an asset is either you can sell the old asset right now when you are replacing it with the new one, or second option is the new asset after using it for 4 years, that is the project life. After using it for 4 years, you will sell that asset. The treatment is going to remain same. Cash salvage value of the asset minus the tax on the profit, because the tax on profit is a cash outflow, and if there is a loss, that will lead to tax savings on the loss. Total CFAT of all the years you will get. Now, the very important thing is you have to be very careful in which year the addition or the deletion is, right? In which year there is a cash inflow or cash outflow, in which year you are the release of working capital is, it might be here also, right? In which year you are selling the asset, in which year there is a profit, in which year what is happening. You have to be very careful with the time period in capital budgeting, right, sir? So this is a very simple statement of the CFAT, that is the cash inflows after taxes. This is how you have to calculate all the expenditures. When we are talking about this total cost, be very careful. All the expenditures which are tax deductible. What I'm saying is all the expenditures which are tax deductible, that means on those expenditures on which we can take the tax benefit, you have to take it before tax. And if there is any expenditure on which the tax benefit is not available, we can take it after taxes. Here you can take it the expenditure if the tax benefit is not available on that, right? So this is another point, because in the ICAI module itself, you have the questions where this kind of a situation you will face, that in some of the expenditures they are taking before tax, and some of the expenditures they are taking after tax. I think it is in back questions, question number 10 is there, which is a very good question, right? So ICAI module questions are very good in the capital budgeting segment. They are very good, sir. Even the additional questions are good in previous year RTPs, MTPs. Some very good questions are there. Right, so this is regarding the statement of CFAT, that is the cash outflows. What is there in the cash outflows? We have discussed about that. What is there in the cash inflows? We have discussed in discussed about that. How to calculate the cash inflows after taxes, which we call it as CFAT. Now, after the ARR, the second technique that is there is the payback period. That is payback period. What is payback period? The payback period says that if you are going to invest 10 lakh rupees, in how many years you will be able to recover that 10 lakh rupees, right? Let's say coming to payback period, the payback period says, let's say today you are investing 1 lakh rupees, right? And every year you will be earning, you will be having a cash inflow of 10,000. Right, this is a cash outflow, this is a cash inflow, this is a cash inflow, this is a cash inflow. Sir, in how many years, in how much time from this 10,000 of the cash inflows you will be able to recover this 1 lakh? So payback period is 1 lakh divided by 10,000. That is, in 10 years, you will recover your original investment of 1 lakh rupees. Right? In 10 years, in a period of 10 years, every year, you will be getting a cash inflow of 10,000 rupees. So in 10 years, you will be able to recover this 1 lakh. Right? So in 10 years, you will be able to recover this 1 lakh. So this is a very simple example in which there are equal cash flows. So in case of equal annual cash flows, initial cash outflow, that is 1 lakh rupees, divided by annual cash flow, that is 10,000. But sir, what will happen in case of unequal annual cash inflows? What will happen in that case? Let's see. Let's try to understand with the help of an example there. Let's try to understand this with the help of an example. Let's say the initial investment, let's say, is rupees 7 lakh. Right? There are different cash flows in the different years. Year 1, year 2, year 3, year 4, you are given the CF80. There are different cash flows in the different years. In the first year, it is 1 lakh. In the second year, it is 2 lakh. In the third year, it is 3 lakh. And in the fourth year, it is 4 lakh rupees. Right? Now you cannot calculate it like this, sir. How will you know that you are going to recover? When are you going to recover the 7 lakh rupees, sir? It is only till 4 lakh. How will you recover it, sir? For this, what is the step is? The first step is to calculate the cumulative CF80. Cumulative CF80 says in the first year, you have recovered 1 lakh rupees. Now, in the year 2, what is the total recovery up till year 2? That is 1 lakh plus 2 lakh, that is 3 lakh rupees. Now, what is the recovery? This 3 lakh means 1 lakh of year 1 plus year 2. Right? Now, year 3, it is 6 lakh. How 6 lakh, sir? The 6 lakh is year 1, year 2 and year 3. What is the total amount of cash inflows till year number 3? This is what is cumulative CF80. Year 4 is 6 lakh plus 4 lakh, 10 lakh rupees. Right? Now, what is the amount that you want to recover? Sir, you want to recover only 7 lakh rupees. When will you recover, sir? Up till year 3, you are recovering 6 lakh. Up till year 4, you are recovering 10 lakh. That means the 7 lakh you will recover somewhere between year 3 and year 4. The cash outflow of 7 lakh you will recover somewhere between year 3 and year 4, right? So from here we will be able to calculate the payback period. What will be the payback period, sir? He says 3 years plus, it will be more than 3 years, less than 4 years. 3 years plus. Now, up till 3 years, what is the amount that you have already recovered from the cash inflows? 6 lakh rupees. This is the amount that you have recovered, sir. What is the remaining amount that you want to recover? 7 lakh is the total amount to be recovered. Up till 3 years, you have already recovered 6 lakh. So what is the remaining amount? Now you want to recover only 1 lakh rupees. Sir, from which cash flows you will be recovering that 1 lakh rupees? From the cash flows of the year 4. Right? From this cash flow, not this cash flow, not from 10 lakh. 10 lakh is not the cash flow of year 4. 10 lakh is the cash flow of year 1 plus 2 plus 3 plus 4. Right? This 1 lakh rupees you will be recovering from only the cash flow of the year 4. This is the only thing that you have to be careful about. Right? So this will come to 3.25 years. This is how you will calculate the payback period in case of unequal cash flows, right? So this is the formula that is also given to you. Year up to which the cumulative CF80 is less than the total cash outflow, right? So that is 3 years. It is less than, the cumulative CF80 is less than the cash outflows. Fine, sir. Plus total cash outflow we have taken 7 lakh. Minus the cumulative CF80 of the year in which the cumulative CF80 is less than the total cash outflow, that is 6 lakh rupees, divided by the CF80, not the cumulative CF80, the CF80 in the next year following the year for which cumulative CF80 has been considered in numerator, right? That means the CF80 of the 4th year. Here we are considering the CF80, cumulative CF80 of year 3. Here we will take the CF80 of the next year, CF80 of year number 4. So this is how the cumulative CF80 will be calculated. This is how the payback period will be calculated. This is all about the payback period. Very simple part, sir. If there are equal cash flows, then it is absolutely simple. But if there are unequal cash flows, then you have to take it accordingly. And these two techniques, with these two techniques, what we have done is, sir, we have covered the non-time adjusted techniques. Right, so with these, ARR is done, we have done the ARR, we have done the payback period. Now comes the time adjusted techniques. What are the time adjusted techniques? I'll just discuss the basic of that. I'll just discuss the basic of that. Then in the next lecture, we will discuss about discounted payback period and all those things, right? So let's try to discuss what are the time adjusted techniques. What do you mean by time adjusted techniques? Time adjusted techniques. Now, this time adjusted techniques, they consider the time value of money. What they do is they consider time value of money. Right? What is meant by this? Let's say you want to make an investment, right? Let's say today you want to make an investment of cash outflow of let's say 10 lakh rupees. And you say to recover this, you will have some cash inflows. This is based on cash inflows and cash outflows. This is based on cash flows basically. And let's say it is a 4-year project. 1, 2, 3, and 4. In the first year, you say you will have a cash inflow of 2 lakh rupees. In the next year, you will have a cash inflow of 3 lakh rupees. In the next year, you will have a cash inflow of 4 lakh rupees. And in the 4th year, you will have a cash inflow of 2 lakh rupees. Now, you will say, sir, this is the total amount. What is this amount? 11 lakh rupees. Sir, you will say by investing 10 lakh rupees, we are earning 11 lakh rupees. That means we are earning a 1 lakh profit from this project, which is a very good thing, right? This is what, as a layman, your interpretation will be. Sir, we are investing 10 lakh rupees and we are earning 11 lakh rupees over a period of 5 years. We are having a project profit of 1 lakh rupees. That is the basic interpretation that you will be having. Is it correct, sir? No. The reason being very simple. The reason is, sir, all this is what? All these are future cash flows. Future cash flows. And he says, in the future, the value of the money changes. The thing that you can buy today worth 5,000 rupees, tomorrow you might not be able to buy the same thing for 5,000 rupees. Its value might change. That is what is known as the time value of money. If you can buy a mobile phone today for 5,000 rupees, tomorrow you might have to spend 5,500 for the same mobile phone. This is what is time value of money. Right? So what he says, when are you going to take the decision? You want to take the decision here. Cash outflows are here. He says, bring the cash inflow values to this point. Calculate the present value of the future cash flows. Present value of future cash flows. Now, how to calculate the present value, sir? For the calculation of present value, you will be given the discounting rate. You will be given the discounting rate, sir. Right? For example, at the rate of 10% to bring those values to the present value. How will you bring it? Let's say this is 0 period and this is first period, right? At first period, this is rupee 1. Now, if I want to find out what will be the value of rupee 1 here at 0 period, this is the future value that I have. I want to calculate what? I want to calculate the present value and the rate is 10%, sir. When you were a small kid, this much of a kid, you have studied the formula for a future value. What is future value, sir? The future value is equal to present value into 1 plus r to the power n. Isn't it? We have all of us have studied this. Now here you have the future value. You want to calculate present value. How will you calculate? Present value will be future value divided by 1 plus r to the power n. Now here the future value is 1 divided by interest rate is 0.10 and 1 is the time period, right? So this value will be 1 divided by 1.10, that is 0.909. Now what is this known as? This is known as present value factor of rupee 1, right, at the end of first year, at the end of first year, discounted at 10%, discounted at 10%, right? So this is what is known as present value factor, right? So sir, what about this present value factors? Now here you have 2 lakh rupees. If you want to find out what is the value of, what is the present value of this 2 lakh rupees, what will you do, sir? He says for 1 rupee the value is 0.909 present value. This is the future value, this is the present value. Future value means at the end of the first year, if it is rupee 1, the present value is 0.909. And if it is 2 lakh, so what will be the present value of 2 lakh, sir? 0.909 multiplied by 2 lakh, right? So this is 2 lakh multiplied by 0.909, that comes to 1,81,800. This is the present value of 2 lakh rupees, right? Sir, what about the present value factors? We will have to calculate the present value factors every time, or it will be given in the question. Most of the times, 99.9% of the times, the present value factors will be given in the question. But if the present value factors are not given in the question, you can simply do the calculations on the calculator also. How, sir? Let's say the discounting rate is given as 10%. You want to calculate the present value factors. How will you calculate, sir? You will do it on the calculator. Take up your calculators. 1 divided by 1.10, right? When you will press equal to, the first equal to will give you the present value factor for year 1, right? Again, when you will press equal to for the second time, that will give you present value factor for year 3. Again, if you will press equal to for the third time, that will give you present value factor year 2, sorry, or for year 3. Again, if you will press equal to for the fourth time, you will get the present value factor for year 4, right? So this is how you can calculate it. If it is 20% that is given to you, if the discounting rate is given as 20%, how can you do it? You will write 1 divided by 1.20. One time equal to, that will give you the present value factor for year 1. Another time equal to for year 2, for year 3, for year 4. This is how you can calculate the present value factors for any of the percentages for any of the years. Clear? Now, certain important things regarding the present value factors. Note down. Make a note of these things. Present value factor will always be taken, for the end of the year. For the end of the year. That means if you are here, this is 0 period, this is first year period, this is second period. So we'll try to find out the present value factors here. This is the present value factor of year 1. Right here, this is the present value factor of year 2. Year 2, this is year 1. Right? It will be always at the end of the period. Now, related to this only, write down another note, sir. Write down another note. What is that? He says, if cash flows are given, if cash flows is at the beginning of the year, cash flows is at the beginning of the year, then present value factor of the previous year will be taken. Of the previous year will be taken. Now, what does it mean, sir? What does it mean? Let's say it is at 0 period. There is a cash outflow of 1 lakh rupees. Right? Now, at the end of the first period, this is what? This is what is known as end of first year, end of first year. And if it is the end of first year, that means it will be the beginning of the second year. It will be the beginning of year 2, isn't it? Now here, let's say at the end, there is a cash inflow of 10,000 rupees. That's fine. Another thing that the question specifies is that there is a cash inflow at the beginning of year 2. At the beginning of year 2, there is a cash inflow. Here also it is a cash inflow of, let's say, 5,000 rupees for any reason. If it is given at the beginning of the year, here you will have to take the present value factor of year 1. Why, sir? That is why I told you that present value factors are always to be taken for the end of the year. Here, the beginning of year 2 means the end of year 1. So, present value factor will be taken for year 1 and not year 2. This is a very big mistake that I have seen students committing. The cash flow is given at the beginning of the year 2, and you are taking the present value factor of year 2. No, sir. You have to take the present value factor of year 1 itself. Right? The third note here is, one second, the third note here is that the present value factor of 0 period is always 1. Is always 1, right? So please remember these 3 notes, very important. One second, very important, sir. These 3 notes are important. Please revise all these things during the examination. Even if you are going to listen to these things one day before the examination, that will be brilliant. That will be great for you, right? And one more thing is there, present value annuity factor. What is present value annuity factor? The sum total of all these present value factors will give you present value annuity factor of 4 years at our percentage, right? This is, we are calculating individually for 1 year, 1 year, 1 year. If I want to take for 4 years, the combined present value for 4 years, that is known as present value annuity factor. Annuity factor of the total 4 years at whatever the percentage will be. Clear? So this is the basics. These were some of the basics regarding the present value factor, so that whatever the further techniques that we will be doing, we do not have to waste time on understanding what is the present value factor, how to calculate the present value factor, and all those things. Right? So in the next lecture, we'll end this lecture here itself. In the next lecture, what we'll do is we will discuss about the discounted payback period, very simple. Then we'll discuss about the NPV. Then we'll discuss about IRR, MIRR, and PI. Right? We'll be able to quickly cover it up. It won't take much of the time. Maximum of 1 more hour that will take for capital budgeting. Right? So stay tuned, guys, for the next lecture on investment decisions and capital budgeting. See you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.